Cash or investing? Most of us are brought up thinking that saving means popping some cash into a bank account that hopefully pays you some interest, and that investing is some incredibly risky thing that rich people do. But is that view actually fair? In this video, we'll break down how risky investing is in reality, the hidden risks of holding too much cash, and how to tell whether investing is right for you. Sure, investing is fundamentally different to cash. There are no guarantees with the stock market, so there's always a chance you could end up with less money than you started with. But it's easy to forget that saving cash is not without risk. There's always the danger that its value will be eaten away by inflation. And history would suggest that when you do it in a sensible way and for the long term, investing isn't as risky as you might think. Let's have a look at the evidence. As you can see from this chart, over the long run, the performance of global stock markets, the blue line, has significantly outperformed cash, the orange line. If you'd invested £1,000 in global stock markets at the beginning of the year 2000, your money would have grown to around £5,000 by May 2025. If you'd have left it in a high-paying cash account over that same time, it would have only grown to around £1,700. True, those investments might have fallen in the short term, and past performance is no guarantee of the future. But still, the difference is striking. And that's assuming you managed to secure a good interest rate for your cash savings. Rising prices in the UK mean that in 2025, it would cost you almost £2,000 to buy goods that back in the year 2000 would have cost you just £1,000. So the value of your money would have essentially halved in real terms if you'd left it earning no interest over that time. If you're worried about losing money, the data also suggests the longer you stay invested, the smaller your chances are of losing money. This second chart shows the best and worst annualized returns. That's average yearly returns you would have experienced had you held shares in the US stock market for 1 year, 5 years, 10 years, or 20 years. You can see that if you'd only stayed invested for 1 year, in the best case scenario, your money would have grown by 61%. But in the worst case scenario, the value could have fallen by around 40%. But the data also shows that if you'd stayed invested for longer periods of 5 or 10 years, that worst case scenario would have improved a lot. By the time you hit a holding period of 20 years, even the worst case scenario would have made investors around 5% a year on average. And in the best case scenario, they'd have enjoyed average returns of 18% a year. Again, remember though that past performance is no guarantee. Of course, there's always a place for cash savings. You never want to be in a position where you're forced to sell investments to access cash quickly. That's why experts generally recommend having a rainy day fund with 3 to 6 months worth of your usual outgoings as easily accessible cash. But if you do have that rainy day fund, no bad debts, and you're comfortable accepting some level of risk with your long-term savings in the hope of better returns, investing could be right for you. Because holding too much cash, especially over the long term, could be really damaging to your finances, making it that much harder to reach your goals, whether that's buying your first home or saving for retirement.